Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.
Welcome to the Stoller Report, Real Estate Trends in the Tri-State Region. My name is Michael Stoller. Money, money, money. That's all we have, money for real estate. Everybody wants to own real estate, and there's so much money out there that you can buy real estate. And you can buy real estate at prices which are astronomical, probably the highest rates we've ever seen in our life. And what better way to talk about real estate is to have the people who are providing that type of money. So I'm very happy tonight to introduce my guests. Chuck Rosenzweig, Managing Director of RBS Greenwich Capital. Drew Fung, Managing Director, Reef, a Deutsche Bank company. Peter Scholar, Managing Director, Wachovia Securities. Bill McCahill, Partner at Apollo Real Estate Advisors. Emily Youssef, President of the New York City Housing Development Corp. And last but definitely not least, Sam Jarusa, Senior Vice President at M&T Bank. So why is there so much money out there? Why does everybody want to give away money? I mean, you know, some of us who are a little older than Mr. Fung or Mr. Fung remember that, you know, we have cycles. We go over situations. The world changes. Sam, you've seen numerous cycles. Bill, you've seen cycles. Even Chuck has seen some cycles, and Peter has. Why is there so much money chasing every type of real estate?
I think like kind of in the post-Enron era when people were, putting a lot of money in the stock market against companies that didn't have cash flow, it was based on an idea. A hard asset like real estate has attracted a lot of capital, and there's a huge amount of capital going to real estate right now, and a lot of money has been raised, but a lot of Main Street USA right now wants to be in real estate because it's a hard asset class. You can see the asset, and it produces cash flow. Other than development deals, which kind of in a different category, a lot of people are very attracted to the fact that there's a steady stream of income, and that's a very good counterpoint to when people lost a lot of money
Billy?
Against companies that didn't have cash flow.
I agree with. I think there's been a movement towards hard assets, and people are spending more money for their homes. They're investing more in real estate because it's a real asset. You can see it, you can touch it, you can sort of believe the numbers that come out of the various reports in the real estate world. There hasn't been a major fraud in real estate in this upturn, and I think after the Enron and similar problems in the stock market, I think the trust factor in real estate is pretty high.
I think also that once people start seeing big returns, whether it the dot-com era and now it's the real estate, and the question while money is still chasing it is because everyone believes that they're not going to be the last one in. But as you know, and thank you for not mentioning me as being someone who's been through the cycles, although God knows I have, I think that once, as soon as the deals start to fall apart, the cycle will happen again. As soon as people start to lose money.
So you're saying that perhaps some deals are going to fall apart today?
Not necessarily fall apart as much as lose money, because the kinds of returns people have been getting in real estate will not last forever, simply because it's a cyclical business like any other business. And I really believe that eventually people are not going to be making the same kind of returns. Would anyone disagree?
I think the return expectations coming down, though. I don't think that's the same. You have a lot of the opportunity money or the hedge fund money that's become really popular. It's put into money into real estate, and they've targeted 20% internal rates of returns. And you've had the private investor who says, well, look at the stock market. I mean, look in the past 2 or 3 weeks. What opportunities have you seen, whether it's in single name securities, unless you're an active trader in that business every day, or even in mutual funds, you probably are down if you bought 3, 4, 5 weeks ago. And real estate people are looking at as a hard asset, as a safe investment, and they're saying to themselves, I'd rather get 5, 6, 7% than lose 10.
But I have two people who are in the opportunity funds. You're in the opportunity funds and part of Apollo. Reef is in the opportunity funds. You can't, if I gave you money, or Chuck gave us money, or any of the other people sitting here gave you money, I'm expecting a return, Peter, well in excess of 5%. How are you producing a return for me, Mr. Investor, of 14% or 16%? How do you do that?
I mean, the people who give us money or entrust money to us are typically institutional in nature, so it could be pension fund money or insurance company general account money.
But
the yields we look at and target for our type of investment are somewhere in the 11-12% net, and it's somewhat of a barbell strategy. We're taking investments that are higher risk, higher leverage, that'll maybe throw off mid-teens or higher, and then we're also doing some sort of lower leverage type investments, which are probably somewhere in the 5, 6, 7%. But on average, we're looking at an 11-12% return. What kind of assets? I mean, the hotel. I mean, various different property types. But we're typically not the senior mortgage, which Chuck and others
for my
we're
viewers.
doing.
Okay, let's explain. It's interesting. Sam is a banker. Sam is with a $52 billion bank who lends their own money in many cases. Chuck is with one of the largest banks in the world, owns you, but in reality what you do is you make a loan and then you sell it on the street, as we call it securitization, a collateralized mortgage. Bill is similar to Drew. He's in an opportunity fund where a pension, a union, a pension, or even a high net worth individual would go over there. Emily's like on the good side of the curve. Okay, these are the dark side because Emily is providing financing for housing and significantly for affordable housing. Now, what do you mean by the senior piece? Well, and Peter, in a similar manner as Chuck, I apologize. Well, what is it? What's the senior piece?
Well, I think the simple definition is it's what Sam does. In that you take a first mortgage on a piece of property, and it can be either a construction loan or an acquisition loan, and you may lend 75, 80% loan to value on that. And then below that layer of debt, we could do mezzanine or a B note type of structure, which would be an instrument that would be secured either directly on the property or through partnership interest on the property, but it would be subordinate to Sam's A piece.
We do that in the affordable world in that we sell bonds, tax exempt and taxable, to raise the money. So we're bringing capital into the affordable market, but then we make second mortgages at 1% to provide a subsidy for the developers, and that is what we keep. When we do securitize it, though, because they're 1% loans, and sometimes we do just to raise additional proceeds, we'll have to securitize 2 to 1. So for $100 million in loans, we're lucky if we can raise $50 million because the value is obviously much higher. It's a very risky position.
Yeah, but one of the reasons, going back to your first question, is that there's so much capital out there chasing real estate. It's not just equity capital. There's a lot of debt capital, and real estate debt has become a much more accepted asset class in the capital markets because of securitization in the CMBS markets, which really kind of became a very, became back in the kind of the mid-90s and became very mature over the last few years, where bond investors have accepted as an asset class similar to a lot of other corporate finance products that are in the capital markets. And because of that, you have tranches of debt. So you have people that want to invest in AAA, down to BBB, down to the mezzanine classes. And because there's a lot of transparency and great reporting, investors, institutional investors, believe this asset class has a lot more consistency in terms of what it can do and where you can invest, and it has a lot of liquidity because these bonds trade. So that's created that type of product has created a lot more liquidity into the real estate marketplace on every level of the capital structure.
But let's not forget the mezzanine piece is the piece that people still are expecting very high returns on because that is the riskier piece.
Right, and
Because
there are
that's
all sorts
higher
of
relative
used to
to
be.
higher relative to more, but
to the
right
senior
now,
debt.
you know, mezzanine pieces are trading at historically tight levels for real estate, much tighter than they were over the last few years, and you know, mezzanine rates range from 250 over to 1,200 over,
Right.
and that's
now
a
for
very
my
big
viewers,
range
Chuck,
depending on what
okay,
the capital is.
What Bill had explained. Let's say you purchase something. Let's use an easy number for. Let's say you bought something for $10 million. Bill is saying you can get 75% on your first mortgage.
Right.
On that, so we have $2.5 million of money. Now, that for my viewers is the mezzanine piece, but it's structured in a variety of ways.
Well, not that entire
No,
thing.
no,
the
I'm
entire
saying
thing, yeah.
a portion of that may be going from 75% to 85%
Right.
is the next layer or the mezzanine piece.
Correct.
And that is yielding a higher return. And then, as some of my guests said last year, because I did a similar show, somebody said you can probably get up to 97% of the money. So that means, we had $7.5 million. We now gave another 10 million or a million.
$1 million.
We're at $1 million,
$1.5.
so we're at $9 million, and then you could even get in this tranche, okay, this higher piece, you can get 700,000. So, Peter, we have not out of a $10 million purchase, we've borrowed $9.7 million at all different prices. My question comes in, that's today. And interest rates today, because everything is tied to sometimes to LIBOR or to Treasury bills, and people see the Treasury bills, and a lot of people, general consumers are saying, hey, I'd rather keep money in the money market because I can get a better rate than the stock market of gambling. But in today's situation, last year a 10-year Treasury note was 4.10. Today, we're talking a 10-year Treasury note is 5.10. That's a 20% increase on the number. What happens 5 years from now when you lend money to this individual? I don't care if it's the 75%, the 15%, or the 12%, and the interest rates, instead of the Treasuries being 5%, are 8%. How does that person pay off the loan?
That's one of the risks, is how you're going to get out of the loan. And when you're analyzing the risk, it's one of the things that at least a portfolio lender is going to be concerned about is just that. Is there a refinance risk at the end of this, and what's your way out of that loan? So when you're analyzing that, obviously that's one of your sensitivities in doing your risk analysis. But let me get back to one thing that I think might have been just a bit awry. There's a difference between mezzanine lending and securitized lending, in a sense that when we're talking about tranches, you may be talking about tranches within the 75% loan to value area rather than just going all the way up to 85 and 95%, where we would be looking at the mezz portion. So what was said about the capital coming into the marketplace after commercial real estate is important to note, that with the advent and with the maturation of the CMBS markets, as these markets have matured and you had better execution, you're getting better economies of scale, obviously better risk ratings from the rating agencies, and consequently more capital following it. The most efficient way to lend, and I'm a portfolio lender, so I do something completely different, but the most efficient way to lend on real estate is to go through the CMBS markets. And I think probably some of my colleagues here can shoot out statistics better than I can, but a very large portion of all real estate lending is now going through that vehicle.
Probably 20 to 25%.
But it's a little over
The best
20%.
guess.
It's 25, but it's grown each year. Has been a record year for the
Incrementally,
last
right,
3 years,
exactly.
and it's grown every year in terms of acceptability with bond buyers and with borrowers as well. in terms of accepting the product, and largely because the rates that we can offer are lower and the proceeds are higher. There are structural features that some people don't like. That some people still like portfolio lending because they don't want to deal with a servicer. I think that's the biggest issue in CMBS right now. I think everything else people kind of check off and say, I get a lot of proceeds and more and pretty good pricing.
Yeah.
And you can be more highly leveraged. But can I just get back to a minute for what you had asked previously? I think if you look back in history and you look at the thrift crisis that really brought them down, one of the big reasons that they came down was that they had they lent so heavily into commercial real estate. And it was an area that most of the thrifts did not have a lot of expertise, internally. And as interest rates rose, the projects couldn't maintain the debt service that they were paying. They couldn't refinance, and projects did fail. And that's always the fear, I think, in a market like this that is so hot and I think you're asking a very good question, because if rates go up high enough, it still is possible that you could have that kind of reaction. Only this time, because the CMBS market is so large, it's probably going to be more likely to be the bondholders, especially the lower tranches, that feel that pain.
But the lower bond tranches are getting, basically very good reward or premium and pricing for what they're taking, as opposed to the thrifts that had it on balance sheet, where here all of the risk is being allocated to the classes or the people or the groups or institutions that are buying it that want that kind of risk. So if you're buying a B piece at 20% yield, you just have to have that 10-year loan last for 5 years. And there will be maturity risk on a lot of deals. That's my opinion. There'll be a lot of refinancing risk, but not a lot of term risk.
Right, but
because the rates that people locked are on fixed rate deals are still the locked rate. They are what they are through the term. So you have to have kind of an issue on the real estate during the term. The refinancing risk is where you'll face the music on where interest rates are. Floating rate deals are shorter term deals, maybe 5-year fixed rate deals. You have potentially a more immediate type of issue with rates going up. The biggest issue in terms of the 10-year deals is a lot of people doing interest only through term. And amortization does help a lot, and structure helps a lot, where you can trap cash if a tenant goes dark or whatever may happen on the property level. And a lot of that has kind of gone by the wayside. But there's been pushback from the capital markets against the interest-only loans and from the BPs.
But that's the key, though. I mean, the thing that we're forgetting about is we're talking about refinance risk, and we're saying, like you asked, that interest rates go up. But I think we're not talking about as much. You run the risk of interest rates go up and the cash flow is not sufficient to refinance at that level. I mean, obviously rates can go up 10, 20, 30%. They can be up 10% rates, 15% rates. But we have to remember that the confluence of events that I think has to happen is that if you finance a property now and there's very little growth, so if you finance a stable property and you maximize leverage and you top it out and it's an aggressive interest rate, and 10 years later that property hasn't seen much growth other than maybe a little bit more than inflationary growth, then I think you have an issue in a higher interest rate environment. But you need the economy, you need the economic impact. A lot of things what happened to the SNLs was that the office market tanked in a lot of markets and tenants did go out.
Let's talk about the office market. I happened to be in Westchester yesterday, and I had lunch with 2 developers who have been in Westchester between 30 to 15 years. And I said to one of them, your rents today are about the same as they were 20 years ago. And the developer said to me, no, my rent is less than it was 20 years ago. Now, if somebody lent money, I mean, you can get a Class B building in White Plains or Westchester, certain markets over there, for $28 a foot. It was $32 a foot 20 years ago or 10 years ago. How do you lend in that market? What happens if the market changes?
There's not a lot of liquidity in those markets. I mean, that's just the bottom line. So,
I mean, not everybody.
Your underlying assumptions on the maturity when you refinance, for instance, as a mezzanine lender, we start with underwriting. What's our exit? How are we going to get repaid?
How are we going to get paid
on this?
Right? Sam looks at it because Sam is taking money. If I'm making a deposit for my viewers, if I give M&T Bank my money, my deposit, I buy a CD. Sam's lending that money to a developer or to an owner. And, that's a risk.
Yeah, but the dynamics are not any different than what anyone else in the equity market is. We're running a company and we're trying to profit out based on the investments or the assets that we're putting on the books. Yes, our strategy is not to own that particular piece of property, and we want repayment because banks don't make very good real estate owners. However, the dynamics of how you profit out are basically the same thing. We're looking exactly the same way as anybody else because we want to know at the end of the day that, number one, we're getting our payments, so we're looking at our cash flows and with the sustainability of those particular cash flows. And at the end, we want to know that we have enough amortization and we've carefully placed amortization in there. No one's going to predict the marketplace. We do have models, and I think 2 years ago I was here, maybe a year ago, I don't remember, a little over a year, and our models were predicting that within that period of time from back then that the interest rate's probably going to go up, 200 basis points, and we're 100 there already, and it's about halfway within a 2-year period. So the prediction is. Rates are going to go up, but how much and where, no one's really going to be able to predict.
Besides rates, prior to the show, we were talking about prices of land. Chuck lends, everybody over here lends money on new construction. New York City is condomania. There are very few new rental apartments, with the exception of what HTC is doing. And today, let's try to explain to my viewers that if somebody wants to buy a piece of property in Manhattan, and then we'll look at it from a lender's point of view also, it's going to cost approximately $300 minimum. I mean, certain properties
per square foot
in Manhattan for that property. Now,
per buildable gross square foot.
A buildable gross square foot. So if I wanted to buy something which has a buildable foot of 100,000 square feet, it's going to cost me $30 million just for the land. Construction costs have gone up through the wall. Construction costs are running how much?
About $450.
$450
For residential.
For residential.
And that's high end because
so fine. Let's use 400, Sam. So if we have 300 and 400. Now the other associated cost is what we call soft cost, which is what?
Because debt service is probably the biggest component.
Interest, which is the debt service.
Architect,
marketing,
legal,
all of this. All of the other situations. That's 30%. So 30% of $700 is another $210. Now you have to build the stairways, you have to build the elevators, you have to do other situations. So you don't have 100,000 square feet that you can sell. You have basically 85% of that, perhaps. So now that $910 means that the cost bill to that developer, who you may have lent a portion of it, you may have lent a portion, you may have lent a portion, is now approximately $1,100. Can everybody make money if it's going to cost them $1,100 to build?
Well, if you're selling at $1,500.
But do you see that happening? I mean, there are 30,000 new apartments coming on the market.
If you're on Central Park's west and facing the park or south or on Fifth Avenue,
your land cost is more.
to a certain extent and get those things. But
the scenario that you just laid out is for what I would say is a ordinary condominium project in Manhattan. I mean, we're not talking about being on Central Park West. We're not talking about being on Fifth Avenue. We're talking maybe mid-block East 28th Street or something like that. That's what it's going to cost. And then you're going in with a cost basis of roughly $1,100 a square foot, which means you're paying well over $1 million for a 1,000 square foot apartment.
No, you're paying. If you cost, I think every developer I know wants to make a profit.
Yeah.
So if it's costing them on
well
1,000, it's
$650.
But that's the thing. That's the point. That the $1,300 or $1,400 mid-block is the one that you have to worry about. I mean, I think you look at it, and when I say that, are you going to pay those types of prices for everything in Manhattan? It's interesting. if you go through the listings, if you go on the websites of every broker in Manhattan, at one point I almost started to laugh because I said to someone, everything's $1,000 a square foot, starting. Everything, and that's like second generation, 1950s construct. Everybody wants 1,000 a square. Every apartment's worth at least 1,000 a square foot in Manhattan. If you look at the listing agents,
Yeah, and it doesn't matter if it's new construction or
and the
you
new
know, a resale or a rehab.
$1,600 a square foot. If you spend $1,500 a square foot and you're on Central Park West and you have the view of the park, or you're on the river, or you're in the prime key areas, you know, I think those certain areas and certain blocks survive over time. If you're 1,500 a square foot and you're in the middle of the block, you know, you hope that you make enough money or you've paid off the mortgage and you can live there for the next 20 years because I think, you know.
I think if you're asking whether the caution light is out and it's blinking, from my perspective, it is. I think this is one place that we as lenders really have to take note. And there's lots of variables that you have to go through. One is location, and you know, land costs, obviously being what they are limiting the possibilities of what you can do with that property once you have it built, because you're going to have to sell it off at those prices in order to, you know, even on a fire sale, you're going to have to sell it for, you know, what you would think is a high per square foot cost, even to break even. And nobody bills those things, takes that kind of risk to break even. I mean, there has to be a built-in profit margin that makes sense. The risk-reward issue comes into play.
But I agree with Sam. I think the caution lights have been on from the lending side, maybe less so than the equity side for residential development. I think there's definitely been a pushback on the lending side for, you know, a lot of deals. On the condo side, a lot of deals have been pulled. Now, I'm not talking about New York City necessarily at all, but there are a number of projects across the country that have been abandoned on the condo development side, conversion and new construction, because the deals didn't pencil. And, you know, developers are willing to forego lawsuits from people who signed contracts just to get out of those deals. And by the way, we don't do construction lending. We have an affiliate company, a sister company that does. I don't think it's a great business. I think the development business is much better from the equity side, because the option of doing a construction loan is, you know, if it works, you get paid very little. And if it doesn't work, you're kind of in the soup with the developer. So I don't think there's a great risk return and risk reward in construction lending. You know, that being said, Manhattan has the most demand out of, you know, by far and away anywhere in the country. And, you know,
but
some of these things may prove out. Maybe 28th Street mid-block will be
Since my
12
show
to
is on
1,500
the
a
five
foot.
boroughs, also in East Hampton, and a lot of people watching on the internet, there are in the borough of Brooklyn, there are 5,900 new units just in downtown Brooklyn. There are 14,000 units planned, or even more, in Williamsburg. And there are other neighborhoods in Harlem and all of the other places. You know, so there's every market. And the problem, what you said, Peter, is, hey, it's $1,000 a foot no matter what, or $1,500.
Well, Brooklyn's not. I think many people have migrated to Brooklyn out of Manhattan because there's a good quality of life there, and there's also somewhat of a discount to the Manhattan condo pricing. And, you know, we did a project over there a while back in Cobble Hill, and it was beginning to really become a neighborhood. And I think we were looking at prices somewhere, it was probably a 40% discount to what,
Yeah, but
what
we
Manhattan
did
was.
have the right
the numbers
numbers
are
in
creeping
Carroll
up in
Gardens,
Brooklyn.
And now
It's
it's begun
yeah.
to grow,
Yeah.
and it's going to start to equalize.
So is that the right number? I mean, that's the whole key. I mean, if you're talking about, I mean, it's interesting. So we talk about Manhattan. We all, you know, either live here or work here, and we're talking about an area where it's
He's in Greenwich. He
$1,500.
lives, he works. We brought him in tonight.
The same thing even in the suburbs. It's $1,500 a square foot, and we look at this, and I think anybody else outside of Manhattan would think this is absolutely crazy. $1 million home isn't a one-bedroom apartment. It's a 6,000 square foot house,
Right.
or it should be somewhere. And I think you look at it, you know, where are you going to go out into the boroughs? Is that right? Because when you're comparing it to $1,000 a square foot or $1,500 a square foot, or now, and you're right, when you look at some of the things that need to be built on Central Park West and some around the park in those prime areas, they're going out at 2,000 square foot to make sense or more. So what is the right number when you go out into some of those areas? Because is a 30% discount right when you're talking about 1,000 square foot?
Well, you
or
know, the
2,000
construction,
square
though,
foot?
for affordable housing, is so much less than that. Some of the things we're looking at in Brooklyn and some of these areas, the land cost is $50 to $75 a square foot, and the construction for like a middle income project is about $225 a square foot. So you're talking a whole different level, and that is the market there.
But that's a better level. I mean, what you're talking about and what you're
It
going
is,
through,
and it makes
safety.
it
because the reason why the
it
income
makes it
disparity is much
affordable,
bigger.
and which is the whole point. Because with all this discussion about $1,000 or $1,500 a square foot, how many people can afford?
How deep is that market?
Yeah, deep is the market. Yeah.
And
That's the
it's
question.
not, and this is where I get back to what happened with the savings and loans and thrifts, because everybody chases it. They think it's the best deal in the world, to invest in something like this. But if you're not building for the people who live there, eventually you're gonna get a real imbalance. Too much property on the market at too high a price, and not enough people who can afford to buy it.
Yeah, because the overall housing need in the city is very acute. I mean,
But it's the affordable housing
affordable housing.
that is
Versus
really
the super luxury market, and how many $2 million apartments,
Yeah.
condos can the
yeah, but
market support
even the
in Manhattan?
numbers like in Williamsburg, I mean, you're still talking about 800,000 for
Schaefer's
a good-sized
Crossing
one bedroom.
is selling for $900 a foot. A minimum of $900 a foot, the non-affordable component.
Right.
Now, we're talking residential, and I have great lenders who understand other areas. Hospitality is really hot. I mean, lenders like lending in hospitality. Why do you like hospitality?
I mean, I liked it a lot more 3 years ago when other people weren't lending against it, frankly. It's definitely in vogue now, and the risk premium for lending on hospitality is not a very good one right now because it's become too accepted an asset class, in my view. It's getting basically spreads that are similar to retail and office. I think some very well-located infill real estate hospitality properties, are things where you get more aggressive. But to me, a lot of hospitality, it's an operating business, and it's a difficult asset class when things aren't going the right way.
And I asked that question prior to the show to Sam. I said, "What's your opinion, hospitality?" And what was your answer?
Well, we do lend on hospitality, but not from the real estate perspective, because we think and look at it as an operating business, and we want that business analyzed. So the dynamics of the analysis is a bit different. So there is another group that does handle hospitality specifically, that deals with hospitality. Now, generally, what do I think? I suppose that I can remember when hospitality was the worst thing you can lend on, and you couldn't find a lender that would lend on them, including Wall Street, who had the best and most efficient way of doing it.
Yeah, but Wall Street, which is where I work, it's really a function of where you can distribute the paper, because it's
exactly, and that's my point.
Because it's an asset class that's very accepted. There's a lot of liquidity for it, that could change very quickly.
It wasn't in vogue, to use your term. I mean, that has turned around, and hospitality obviously has gotten better, and now spreads have come down, and it is in vogue, and why it is the question of other types of dynamics that are going on in the United States.
I think it's not a question of, though, you can't say it's necessarily. I think the viewpoint of it, and I've lent a lot in hospitality and done a lot of the larger transactions, taking larger companies private and worked on all those deals. And I think in vogue, if hospitality is in vogue, then I think our entire industry is in vogue. Because I think that the reality is, and maybe that's the case, but I think
so you're saying all type of lending is in vogue?
Well, I just think, the people didn't understand the hotel market. I think, first of all, I think you have more expertise in it now. I think people understood what went wrong. But, the travel industry has gone through 9/11. It's gone through SARS. We've seen more stress and externalities in that business than we have in any other business, and we've seen it rebound. I know where I can say to myself, if I want to see where the bottom is of an asset, or especially in any real estate asset right now, I can look to a hotel with way more transparency than I can see any other piece of real estate right now in any other sector, whether it's office, retail, or anything else. So I can look at a hotel and see what it did after 9/11 and say to myself, in particular markets, and this is a general statement, you have to be market specific and say, well, that was the bottom. And where it's gone since 9/11 and its ability to rebound and compete.
But the
Those are
issue with
telling
hotels,
statistics.
I mean, is you really have to rent your rooms every night. So you're marking to market
Reprice every night.
every night. You're
Absolutely.
marking to market, as opposed to retail and office. In multifamily, you have 1-year leases, I guess. But here, just overnight things can change dramatically. And when you're writing, when you're writing a high, high leverage loan with a sub 7% cap rate on valuation, you got to wonder about what that's going to look like.
Depends on where
if
you're
things
buying it on
change.
the cycle. Remember that. I mean, you look at that and you say, if I'm looking at hotels in New York City, I mean, try to get a room in New York. Come into the city from out of state. People, our bank is based in Charlotte. We get people coming up all the time, and they're spending $700-800 a room, or what they're getting offered because they can't find anything. And I think the reality is that hotels, depending on where you are in the cycle, well, at least had some upside. I think in the past 2 or 3 years, if you bought a hotel, you're pretty happy with what your cash flows are
But
right now.
as good as the hotel market is, and it is very solid in New York and some of the other major cities, there has been very few hotels built without a residential component attached to it.
Well, those
over
are,
the last
I
couple of
agree with
years.
that. Those are a little bit off. I mean, some of those are, again, I think it's really extremely location and quality specific.
Yeah, but without the condo sales, the cost basis of doing a hotel in Midtown New York, it's really tough to get the numbers to work on new construction.
And this is as good as it's ever been, because it's
Yeah.
never been good to be the first owner of a hotel. I mean,
Because,
that's just 90% of the first owners of hotels have given them back, or had to wait
Right.
15 years to make it actually look like a cash flow positive
I
deal.
mean, you're back to the same construction cost problem that we talked about before. And most of the hotels that have been built in Boston, Washington, San Francisco, you have a Ritz-Carlton or Four Seasons in the base and condos up above, where you're selling the condos at a huge premium, which brought down the cost base on the hotel portion, and that's how it worked. But with the nervousness about the condo market, and I question how many hotels are really going to get built. That's why if you have an existing asset in a hotel, I think you're in pretty good shape.
That's all the better. The reason why I think the business model works better, because if in fact the matter is, if there's less future supply coming online and you do own those assets, I think you have that much more of an argument to say that your assets a little bit, I don't want to say safer, but you're cash flowing. I like the fact that you have to sell a room every night, because I like to be, while you can take the downs and the up cycles, you get to take that up cycle. And if you get a certain type of hotel and you have future bookings, I think you can mitigate a lot of that. I mean, on the flip side is you have an office building when Manhattan rents were $70 a square foot, and then you are refinancing later in a higher interest rate environment, and rents have gone down.
Right. Let's talk about office buildings. Forget Midtown, because Midtown is hot. Everything, prices are hot. Lower Manhattan is still down. I mean, Sam, would you lend money on an office building in Lower Manhattan?
Selectively.
How do you make that determination of selectively? And
I think I was one of the first banks to lend down there after the last downturn in the late 80s, early 90s. And, it's a selection process. It's who's in the building at that particular time, how much vacancy there is, where you think the potential is, and what it works for. Obviously important to the whole analysis as well, and is who's behind this building and what they can do for it. So it's difficult to say on it. If you're asking me what I would lend per square foot on a building down there, that's really difficult to.
No, I was really all I was really looking at was to see your perception of the office market in Lower Manhattan. I mean, there have been some. Most of the deals are small deals. I mean, there are some large deals that guys like Greenwich and Reef and Deutsche Bank and Wachovia have done in Lower Manhattan. But Lower Manhattan, with the exception of the World Financial Center or a selected number of buildings, the rents are still $25 to $30 a foot.
And I think that's a good point that you brought up that type of building. And where I sit and what I would be lending on down there is not in that class. I wouldn't be lending on the A office buildings, the Class A office buildings down there. I'm looking at B, maybe C type stuff.
I mean, Emily's office is at 110 William Street. It's a B plus building.
But we're happy there.
No, it's a B plus building, and if you go down to Wall Street, I mean, Wall Street today, most of the buildings on Wall Street, which HTC has provided financing for a number of them, have been converted to residential.
Right. It's interesting because the last Liberty bond we did just last week, 20 Exchange, has a combination. So they're leaving a lot of the commercial tenants in and doing, it's market rate housing, but combining it in market rate housing. And I think that's a trend you're going to see more of down there, just from the developers that we discuss who all are buying properties, en masse.
Yeah, and some people like Kent Swig has done very well in that market. I mean, he's bought buildings, he's renovated them, and he's really marketed to small space users,
Right.
which is the bulk of the market.
He's our
down there.
landlord, actually.
Right, and he's done an excellent job, and it's made some money.
There's clearly a great price differential for
Yeah.
being down there. I mean, and not everybody can pay the rent in Midtown, which is going up every week right now. So it's it's definitely it's not like you're going to another city.
Let's go to office, and let's go from a lender's perspective to what we call Long Island City. Not the residential market, let's talk about the office market. There are certain plans for certain office buildings. Do you see, would any of you, I mean, except for Emily, because that's not her area, would you be interested in lending money in Long Island City?
For
Drew?
new office construction?
Brand new, I mean,
Inspect.
there's no...
Probably not.
There aren't too many office buildings.
There aren't too many.
Blue
Round
Secret,
ups on a spec
Secret
basis,
Saloon.
it'd be a pretty tough sell, particularly if you were doing higher leverage kind of thing. So assuming there was a construction lender there who was willing to do the construction loan to go and do additional leverage there without sort of an anchor tenant of some sort, and with downtown still having significant supply to come in downtown Manhattan, I'm talking about, and significant vacancy in downtown, I don't see a real great impetus to do anything in Long Island. So
I think the city would have to give pretty good incentives for people to go there. Like Newport in Jersey City to me is kind of a similar market where a lot was given away to get tenants to move from Lower Manhattan, across the river. And I think similarly in Long Island City, that's to me kind of the same zone or distance that you have in the same kind of market.
probably not as good a transportation hub at this
Not
point.
as good and not as good views,
Right.
similar
Yeah.
views. But, yeah.
Well, in another life, I financed Browse and his renovation out there. We brought in Metropolitan Life, which was easy to do since it was leased to Metropolitan Life up front. But I was surprised going out to that building how easy it is to get there from Midtown
There are
Manhattan.
7 trains that go to Long Island City.
There's 7 trains, and it's very
They're always
quick.
broken down, but there are 7 trains.
And it's actually quicker to get from Long Island City to Midtown. Let's say Midtown is the Citibank building. It's much quicker than coming up from Wall Street. Much quicker.
What about Brooklyn?
It's a state of mind problem.
What about lending in Brooklyn?
For residential or office or?
I'm just opening it up.
don't
Okay,
think
you know,
there's
Brooklyn
I don't
has
think-
downtown
Great.
Brooklyn has lots of
Yeah,
retail.
there's a lot of activity in Brooklyn. I think it's got more and more of a buzz to it. But I think any of these markets, I think that it follows a progression. And I think the progression, to a certain extent, starts in Midtown Manhattan. As Midtown gets more and more expensive, as we talked about, as that price point gets up, exactly what you kind of saw start pre 9/11 and the like. You started, the price point started to get high in Midtown. So what happened? You started to see people start to gravitate towards downtown because of the at the time mid-30s, $40 rents. We started to see a lot, and then I think at one point you start to get priced out of Manhattan completely. And as you get priced out of Manhattan, you consider these other markets, and as you consider the other markets, they start to grow. But I think as you still have supply downtown, and I think Midtown's got a little bit, it's getting there every week, but I think it's got a little bit more room to work. Once you start hearing about the person who's signing at $90 a square foot, or they're signing at $100 a square foot, I think you're going to start seeing a lot of people start gravitating towards downtown. Downtown starts to fill a bit. Mm-hmm. That rent starts to get up, and people say, well, why should I spend $40 downtown, $45 downtown, or mid-30s? And then they move out into the other, what I would say the supporting markets. So I think that dynamic is starting. It seems like it's starting in Midtown. It's interesting to see. It'll be interesting to see how it happens if downtown starts to fill, and then there's other markets start to fill up.
I mean, in terms of Brooklyn is pretty large. It's hard to generalize about Brooklyn because the parts of Brooklyn that are closer to Lower Manhattan feel a lot more, at least for the residential aspect, a lot more like what Lower Manhattan was 20 years ago than what Lower Manhattan is right now. So, I mean, it is a desirable place, you know, and very high priced in some close-in areas to Lower Manhattan. And then as you get further out, it's different. So it's a hard place to generalize about, but clearly a lot of Brooklyn is very much in vogue, and there's a lot of development going on.
Prior to the show, we were talking about, you know, the administration has done some great jobs with what they've done in Williamsburg and some of the properties in the Bronx and other areas. You know, we have Coney Island, which has been really nothing's really happened in a number of years in Coney Island. We have Rockaway, which is a 30-year situation that they're building. You know, you're an opportunity lender. You take some risk, not too much. Would you go into some of these other areas?
Absolutely. I think that it has to be the right confluence of economic incentives, potentially from the city or what have you, but also
True.
you can see it
the
coming.
Cyclone. You can go to the Cyclone. You can go to Nathan's. I mean, you know, you can have all this.
Parachute
We're looking
jump.
at a large land loan right now on Coney Island development.
So you would
Bridge loan, land loan, not development, but land. You're just bridging
Now,
the land.
let's remember, land development, Coney Island is not zoned. It's like when there were loans in Williamsburg. You're taking a little risk. Hopefully, the administration will will agree to this.
Well, you know, what I find interesting in all of these areas that you've seen big turnarounds, I think a lot of it has to do with the city making such a push for affordable housing. And seriously, if you look at Harlem and where the prices are up there in West Harlem, it started off being very, the low-income buildings being built, then moderate, then middle, and co-ops, and now there are market-rate condos going for over $1 million up there. So I think the same thing is beginning to happen because we are having developers come in and talk to us about doing things in Coney Island and other areas. And when you get a good, strong housing base and the market stabilize, I think it really, then the services have to follow, which starts with retail. And then when you have the retail, then eventually more commercial comes in. So I think it's a trend, and as we're beginning to see, I kind of feel like we're on the front line as we're beginning to see interest in communities to build that haven't built for a long time. That is the first step that community's on its way up.
You know,
Yeah,
it's
and you have
interesting.
some major deals going on too in the Rockaway. You know, Benjamin's out there with a huge project, and
Right.
I think you're going to see a lot happen in those areas in Brooklyn over the next couple of years.
You know, Chuck, made a loan a number of years ago in Harlem. I mean, Harlem, USA, nothing was there. I mean, Harlem had no retail with the exception of the Pathmark, which took them 30 years to get it done. You know, that was an interesting development.
Well, it was a pioneering development, and I think for the developers, it was hard to get tenants to commit to the area, especially, on a one-off basis. I think you needed to get a bunch of them to commit before, they would say we're really in. From my perspective, I think it was so much in need that it was a pretty easy decision that that it would eventually work. Nobody would have realized that that the prices in Harlem for residential and for land and the like would be where they are today. But for just in terms of just the demand for that type of retail, to me it was a pretty easy decision.
I want to say something about a lot of this discussion has revolved around development and new development within particular areas in the city. I think one of the things that I'll take a little commercial break for M&T Bank here, but we have been lending in the areas that we talked about, both in Harlem and in Coney Island and all parts of Brooklyn for many years. And I think that the beginning of all of the new development was spurred on, obviously, by investors who had gone in there and had taken existing buildings and taken them to the next level. did all of the work that they needed to do to get the MCIs in there and made these buildings an investment that people would go after. And as that has built up throughout the years, obviously more and more people have turned their heads and said, well, maybe I can do something that, in Harlem, West Harlem, East Harlem, whatever the case is. And, the dirty word back then was gentrification. We don't want anybody coming here gentrifying our neighborhoods. But I think in the end result, now we see exactly what the benefits are to neighborhoods like that, which were basically called fringe areas at that particular time. But the pioneers who were in there first, looking at these buildings and financing them for owners and developers that were coming in, I think laid the foundation and the pavement for all of this new development now. So 20 years ago, I could remember going up there, and some of the same names that I do who started out investing in those properties, and today they're major developers in the city. So a lot of that credit has to go to banks and financial institutions that were out there in the beginning.
What about the far west side? We've got plenty of land over there, a need. Maybe you want to do an office building. Well, what's your opinion? Would you lend to the far west side? Would you be the would you be the pioneer to lend money for a new office building on the far west side?
I think if it can compete price-wise with the Midtown corridor, we'd seriously consider that. Because if the land can be a little bit cheaper, if you can get the right floor plate, given what tenants are looking for today, there's very little space available in Midtown. It's got to go someplace.
The only issue there, I think, that we would probably look at is transportation and capability of moving people about.
That's
because
the
you
biggest
have a
issue.
major office building over there. You can be, a good walk from subway and bus lines over there. So
Mayor's working on it.
Chuck brought up, as some people call the sixth borough, Jersey City. As Josh Muss has said to me on my show, they're not the sixth borough. Jersey City has really moved. Newport is celebrating its 20th anniversary. You have a shopping center there. They're building a hotel. What do you think of lending in Jersey City, Hoboken, Weehawken? I know you guys have lent some money there.
Yeah, no, we've done a lot in those markets, and when you look at what's happening in the New Jersey coastline, and you compare it to Long Island City, you can sort of see what's going to happen in the future in Long Island City, because it took a long time for these markets to really get going. I mean, when Newport was first started by the Lefracks, it had some ups and downs, but then finally it really took off, and so did the rest of Jersey City and Hoboken. But it took about 10, 12 years.
And a lot of incentives from the state.
And a lot of incentives from the state to make it happen.
I also think it didn't also take off. When you look at the last years, I mean, you have to look at, I think, at the economy too. I think you look at how hard charging we've been in the last 10 years. I mean, you can't look at, you look at where we are right now, and we have a lot of volatility. But I'm firmly convinced that it's all the wealth, it's all the capital that's been created. It's the efficiency. All these markets that we're talking about are offshoots of efficiency. They're offshoots of putting more money to work, having more money to work. Overall, a better economy. We've seen record unemployment for the last 15 years. We've seen, we go through our hiccups, but we rebound fairly quickly, and we're adding new jobs. And I don't think if you didn't have that underlying a lot of this, I don't think we would be talking about the expansion of some of these areas that we're seeing. I think these areas would still be, behind the 8 ball for 10, 15, 20 years. I think it's really because you're pushing people with a lot of money out of Manhattan. And as you do that, as long as Manhattan continues to grow and it becomes more constricted, you'll have these areas that I think will prosper. Maybe they won't be at the same pace, but there's going to be growth there. So I'd be bullish on it for the long term.
Last year, $22 billion was sold on office buildings and commercial property in the 5 boroughs. This year, that number is going to be exceeded. But this year, we've seen a phenomenon. We've seen a phenomenon that we're seeing office buildings being acquired by a variety of entities for $1,000 a foot.
I think you have such a limited amount of space here. You really do. And it's New York City. And to compare New York City and take it to the other hot market in the country right now that everybody loves, Washington, D.C. Ironically, you have the 2 biggest target markets and the 2 biggest headline markets in the world.
The 2 biggest targets.
And the 2 biggest targets.
Wait, you said, I don't hope it happens, but what happens if there is a threat? What happens if something goes like...
As long as it's inhabitable, as long as it goes through, it happens the same thing that we go before. And I think you rebound quicker. Because no one, it's called national pride, no one's going to let it stay down. We didn't stay down. Ultimately, the effects of 9/11, the life effect you can never get over. And, what happened, you can never get over. But it moved on. The market, there was a lot of pride in opening that market up as quickly as it did after an event like that. And it sold off, and it was 500 basis points, but people came back. People were going downtown and buying newspapers from people in the stands. And, Larry Silverstein's still out there saying, we're going to build, and he's advancing, his kind of plans. And the reality is I think people look at real estate because there's a lot of underlying money. There's a lot of underlying capital. I still think that people have said to me who've worked for hedge funds and have said, would I expect, who targeted the 20% returns, and they look at their personal wealth and they say, 7%, I'll take it versus -10.
People never realize that 58 minutes go that fast when you're having a nice conversation with friends. And I think my viewers and I have got a pretty good perspective on what lenders really feel about lending in the tri-state region. I'd like to thank all of you for being here, specifically Chuck Rosenzweig, Managing Director of RBS Greenwich Capital, Drew Fung, Managing Director, Reef, a Deutsche Bank company, Peter Scholar, Managing Director of Wachovia Securities, Bill McCahill, Partner at Apollo Real Estate Advisors, our affordable housing expert and good friend, Emily Yusuf, President of the New York City Housing Development Corporation, and last but not least, our traditional lender, our good friend and our returnee, Sam Jarusa. Today ends it's my 75th show of the Stoller Report. We will be back in September, and we will be talking, our first show in September will be on Lower Manhattan, 5 years after. And we also return in September with Building New York, the profiles of the people responsible for building New York. Thank you.
Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.